On January 1st, China's Ministry of Commerce quietly closed the door that kept Western silver markets functional. No press conference, no alarm. Just a licensing requirement that effectively ended the arbitrage flow that allowed paper silver on COMEX to pretend it was backed by real metal. 6.9. That is the number left standing once that door closed. 6.9 paper claims for every single ounce of registered, deliverable silver in a COMEX vault right now. If you hold paper silver, that is not a market statistic. That is the odds on your position paying out in metal instead of a cash apology. April 1st notice day is 17 days out. The drain is running at approximately 785,000 ounces per day. China did not announce a war. They filed a licensing change. And the bluff that Western paper markets have been running for 30 years just got called without a single shot fired. I am going to show you exactly what the 6.9 coverage ratio means structurally, why China's MOFCOM licensing change that took effect January 1st removed the pressure valve that kept this ratio from blowing, why the SGE is pricing silver at a premium that functions as a real-time drain signal, and what each of you, whether you hold physical paper or nothing yet, needs to watch in the next 17 days. This channel exists because there's a gap between what financial media covers and what the warehouse data actually says. They will tell you about futures volatility and margin hikes. They will not tell you that COMEX registered silver has declined roughly 75% from its peak in 2020. That is not a coincidence. That is a structural shift. And the 6.9 ratio you just heard is where that shift is showing up right now in verifiable CME data. If you want to understand the signal before it makes the front page, this is the door. Drop Bluff in the comments right now. If this is the kind of analysis you want reaching more people, hit subscribe and drop a like. The algorithm needs a signal the same way the market does. Give it one. The 6.9 ratio only makes sense when you understand the difference between registered and eligible silver, and most people skip past that distinction. That skip is expensive. COMEX warehouses hold two categories of silver. Eligible silver meets quality standards and sits in approved vaults. The owners are using those vaults for storage. That silver is not available for delivery unless the owner specifically converts it. Registered silver has a warehouse receipt attached. It can be delivered against a futures contract. That is the only category that matters when a contract comes due. As of March 5th, registered silver sat at approximately 81.7 million ounces. Total open interest on COMEX silver futures, based on the most recent reporting, represents paper claims against approximately 560 million ounces. That is where the 6.9 figure comes from. It is not a conspiracy calculation. It is warehouse data divided by open interest. Both numbers come from CME Group's own publications. The bull case says this ratio is normal because most of that open interest never converts to delivery. Historically, that is true. Historically, less than 5% of silver futures contracts result in physical delivery. But here is what that argument skips. 2025 was not historical. Total COMEX silver deliveries in 2025 reached 474.4 million ounces. That is more than double the 202.7 million ounces delivered in 2024. Every single month in 2025 showed higher deliveries year over year. That is not a normal market rolling paper positions forward. Something changed. On March 1st notice day, 10,526 contracts stood for delivery. That is 52.63 million ounces, against 81.7 million ounces registered, more than 60% of deliverable inventory claimed in a single day. There's one number in the delivery pattern that I want to come back to after we get through the China piece, because when you understand what happened on January 29th and what happened 18 days later on February 6th, it reframes what the March 1st notice day demand actually means. Hold that. Now the China piece. And this is the part that changes the pressure calculation. For decades, when COMEX delivery stress built up, traders arbitraged it. Buy metal in London or New York, ship east, capture the spread. The mechanism worked because physical silver could move freely enough to rebalance. That mechanism had a structural limit in China due to the 13% VAT on silver imports. But traders absorbed that cost when premiums were wide enough. On October 30th, 2025, China's Ministry of Commerce announced new silver export licensing requirements, confirmed by the South China Morning Post, and taking effect January 1st, 2026. Under the new system, exporters must be approved state trading enterprises. To qualify, firms must demonstrate annual silver production of at least 80 tons and consistent export records from 2022 through 2024. This is not a blanket ban. New applicants without that track record cannot qualify. What it does is gate the supply flowing out of China through a very small licensed bottleneck. China controls a dominant share of global silver refining capacity. Gating that export channel is not a neutral act. The SGE silver price, converted using the structural VAT-adjusted methodology, And I want to be transparent here. The SGE live data requires a direct exchange login, so this figure is a derived estimate, not a direct official quote, is running at approximately $93.20 per ounce. That is approximately $9.70 per ounce above the COMEX spot price of around $83.50, 11.6%. When that premium exceeds $5, the western to eastern arbitrage flow is active. When it exceeds $9, it is aggressive. This is the drain signal. Metal is being bid away from western vaults at a premium. The MOFCOM licensing change means the flow is now directional with no comparable return path. Under normal conditions, the 1-month silver lease rate in London trades near 0%. Some market analysts, citing data from multiple independent sources, report that rate has surged to above 6.5%. I want to flag clearly that this figure comes from independent analyst reports rather than LBMA official publications, so treat it as a directional signal rather than a confirmed number. But the directionality is consistent with what the COMEX registered inventory data shows on its own. Here is what lease rates actually measure. When a bank or dealer lends physical silver, they charge a lease rate. Under normal supply conditions, they barely charge anything because silver is available. When physical silver is scarce and lenders do not want to part with it, that rate climbs. A lease rate above 6% does not happen in a well-supplied market. That is physical scarcity showing up in the lending market, not in a news headline. Now close the loop I opened earlier. On January 29, 2026, COMEX silver futures hit $121.78 per ounce, an all-time high. 18 days later, on February 6th, silver crashed to $63.90, a 47.5% collapse in 18 days. CME Group raised margin requirements repeatedly during that period. Leveraged participants were forced to liquidate en masse. The price cratered. Here is what the counter-argument gets right and what it gets wrong. The COMEX system did not default. The counter case is correct about that. The exchange has tools, margin hikes, position limits, cash settlement alternatives. Those tools worked in February. They absorbed the pressure. What the counter case does not address is what those tools actually mean for a paper silver holder when they get deployed. Cash settlement means you get dollars instead of metal. If you were expecting physical delivery, the dollars you receive may not buy the same ounce at the price the squeeze produces. That is not a default in the legal sense, but it is exactly what calling the bluff means in practice. The paper promise is honored in currency, not in metal. The Silver Institute projects 2026 as the 6th consecutive year of structural deficit in the global silver market. The projected gap is 67.2 million ounces. Industrial demand, solar panels, electric vehicles, semiconductors, 5G, AI hardware, runs above 650 million ounces annually. Mine supply runs around 820 million ounces. The math only closes through inventory drawdown, and inventories have been drawing down for 5 consecutive years. Algos can manipulate the chop. They cannot manufacture new silver mines. Banks can run paper games. They cannot create 67 million ounces a year out of nothing. Let me be direct. The story here is not that COMEX will fail tomorrow. It is that the structural conditions that allowed paper silver to trade as equivalent to physical silver are deteriorating in real time, with verifiable data behind each step of that deterioration. Now verify this yourself. Check CME Group's daily warehouse report at cmegroup.com. Check the Metals Issues and Stops MTD report for March delivery figures. Check the Silver Institute's supply and demand data. Check the South China Morning Post's December 31st, 2025 coverage of MOFCOM's export licensing announcement. The ones who actually verify sources realize this is not hype. The ones who do that homework understand what is building here without needing anyone to explain it after the fact. Physical holders, the fundamentals behind your position have not changed. Registered COMEX drawdown is structural. The SGE premium is directionally consistent. Hold position. Watch the April 1st notice day. Nothing in today's data changes the underlying thesis that drove your allocation. This is education, not financial advice. Use your own brain. Futures traders. The 6.9 coverage ratio is not a buy signal by itself. Futures are a leveraged instrument in a market that demonstrated 47% downside volatility in 18 days. If you are long, watch margin requirement announcements closely. CME margin hikes in February forced liquidations that had nothing to do with the physical picture. The paper market can disconnect from physical fundamentals in ways that are painful on a short-time horizon, even when you are right on the long-term thesis. This is education, not financial advice. Use your own brain. ETF investors holding SLV or comparable products understand that these instruments track the paper price. If COMEX moves toward cash settlement on any delivery cycle, the ETF price tracks the cash-settled outcome, not the physical squeeze price. Review your fund's prospectus on how it handles delivery stress. This is education, not financial advice. Use your own brain. If you're watching from the sidelines, 17 days to April 1st notice day, watch whether registered inventory stabilizes or continues declining. Watch whether the SGE premium holds above $9. Watch whether CME Group announces any emergency measures. Those 3 data points together will tell you more than any single headline. This is education, not financial advice. Use your own brain. Scenario 1, bullish. Registered inventory fails to recover before April 1st notice day. Delivery demand runs at or above February and March levels. The coverage ratio tightens further, forcing eligible to registered conversions, potential margin escalation, and a price spike that takes silver back toward and possibly through the January high of $121.78. Probability, 50%. Scenario 2, neutral. Eligible silver converts into registered in sufficient volume to buffer April demand. Paper to physical ratio improves modestly. Silver consolidates in the $80 to $95 range through April. The structural deficit thesis remains intact but does not accelerate. Probability, 35%. Scenario 3, bearish. CME raises margin requirements aggressively before April 1st notice day, forcing another leveraged liquidation event similar to February 6th. Silver drops toward the $65 to $70 range, despite the physical thesis being unchanged. This is a paper market event, not a fundamental one. Probability, 15%. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research. Always. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.